All right. Hey, everyone. Welcome to another episode of Market Trading. I am your host, Tone Vays. I need to fix my camera. Welcome to another episode of Market. I don't have a good solution for this. Like I'm zoomed in enough and not enough at the same time. That's too much. Hold on. Nope. Always mirror image. Okay. Oh, yes, we do it this way. All right. And all right. I don't know, it's just crazy with this camera. My zoom is well, like what shows me on Zoom is different how it comes out on YouTube, which is super annoying. I usually like Logitech products, but they are $200 4K camera is a piece of crap. Don't buy that. The Brio $170 camera sucks, and that's what I'm using right now. Anyway, let's go to the charts. We got a big day today, and then we go from there. Alex, thank you so much for being a big fan. Right, so I already have the Fed speech ready to go. That's going to take place at 2:30. We're going to see the market move big time at exactly 2 p.m. and 1 micromillisecond, because that's how fast the bots read Powell's statement. And then he's going to come out at 2:30 and actually read the same exact statement that the bots have already read. And now it's all going to be about the tone of his voice, no pun intended, and the eye contact that he makes and how many times he touches his nose. And I don't really want to drink alcohol today, but last time I was doing a shot every time he said the word inflation, and that got me pretty damn drunk. So we're not going to be doing a drinking game today to Powell's speech. Maybe we'll do it next time. When is next time? Oh, next time is going to be the 14th of June. Yeah, I will probably be up at my cabin. So we will definitely do a drinking game for June 14th and Powell's speech. Let's take a look at the latest expectations. He's causing the collapse of about 6 banks right now. And the expectation remains that it's going to be 25 basis points. Okay, let's review the markets real quick. We got 13 minutes before things go haywire. Long-term chart, I'm still thinking is going to be the pink path, where we are not really going to break 50K until a lot closer to the halving. That's just my opinion. Of course, anything can happen. Nope, skipping that. Whoa, why did everything just go dark? Okay, right on. Our weekly chart, Bitcoin is rallying nicely here as we're witnessing the collapse of some regional banks. Regional banks are not crazy important. No one gives a shit about regional banks. All those banks I looked at the other day, I already forgot all their names. Like the banks that have already collapsed. According to the government, these are not important. There's only about a dozen banks that are important to the government. They are JP Morgan, Bank of America, Wells Fargo, Citibank, and I don't know, maybe 3 more. And that's it. And that's the list. And if the all other banks go bankrupt and get removed and are no longer independent companies, the happier our tyrannical leaders are, because they are huge in favor of big industry. They are in favor of big tech. They are in favor of big banks. They are not in favor of competition. They do not want competition. They want there to be one source of information, or the illusion of 8 news channels, but in reality, there is only one company in the back of all of those channels that write the script to the teleprompter. I don't know if you guys knew this. Like ABC, CBS, NBC, Fox to a lesser extent, but I think there's only two companies that write the script for the teleprompter of all these newscasters. These companies like CBS and NBC, they don't have their own independent writers. This is why you hear the same catchphrases. You just don't have enough diversity in language when you have two companies probably pretending that there's two companies, but it's really one company that actually writes the news teleprompter scripts. The news companies outsource this. You can fact check me on this. I'm not going to be going around Googling this stuff, but you are welcome to research the fact that there's only two companies that you probably have never heard of that write all of the script for all of these news channels. They don't write it themselves. It's all an illusion. So the government is in favor of the collapse of the small community regional banks. They want everyone funneled into the big banks. Well, again, the initial announcement usually tanks the market. I've talked about this many times. I strongly advise people to Google for a paper called, what page is this? I just want to be sure. It's page 32 on, all right, page 30 or 32. Google this, the pre-FOMC announcement drift. It was a paper written originally in 2011, revised in 2013 by the Fed. The Federal Reserve wrote this paper. And now we're going to go to page 32. And here is the big dip that happens the moment they announce what the rate is. This used to be done at 2:15. Now it is done at 2 o'clock. That's why the time here is different. And right there, 2:15, but now it's 2 p.m. They changed it. I don't know why, but they just changed it. So at 2 p.m., the market does crash and then it recovers. But the point of this paper was to illustrate that for 20 years, all of the gains of the S&P 500 could be replicated by holding the S&P 500 on these 3 days and only these 3 days, and that's it. Okay, so this is why I'm always expecting this to be a bullish day, statistically speaking. This work has been revised many times. There's been numerous attempts to just continue this research because it's very, very simple research. You just look at what the S&P does on these 3 days versus the rest of the year. And you can see how many of these days take place in a single year. So here we are. In a single year, we have 1, 2, 3, 4, 5, 6, 7, 8. And that's the May one. 8, only 8. Oh, I really thought there were 10. But it looks like there's only 8 of these days per year. I don't know why I thought there was 10. I thought there was 10. But it looks like there's only 8 because then, then May makes it, a new year starting today. So that's 8 announcement days multiplied by 3 days of market returns. So 24 days. 24 days replicate the entire move of the S&P 500 for the last 30 plus years. All you have to do is, you can replicate the monster return of the S&P 500 since 1994. I mean, I would love to just take the time and do all this validation myself and do all the work myself. Like, what would happen if I bought the S&P 500 at market open on the day of or market close the day before? So you can do all this kind of analysis, and you can come up with your own research and validate these facts up to this point as to how lucrative it has been holding the S&P 500 or the Dow or the NASDAQ. And you can even do a research, which one was it more advantageous to hold, S&P, Dow, or NASDAQ? I mean, you can really go down this rabbit hole. But the point stands that the day of the announcement and the day before the announcement, and to a lesser extent, the day after the announcement, have been the most lucrative days on average to hold the stock market. Okay. So it looks like if we look at the mempool, we have 1 day to go before a difficulty adjustment. And it's very, very possible that this difficulty adjustment is going to be to the downside, which is kind of strange because I thought that the blocks were happening fairly often recently. Super interesting. The mempool is a bit clogged. Once again, the Bitcoin maxis that hate ordinals are having a major hissy fits. I personally, don't care, but there are good arguments on both sides. Let's go to our allocation. Our allocation remains at 100% bullish position. I am not scared of the FOMC. Even if they raise it 25 basis points, which they likely will, they're going to be very, very cautious and very, very dovish in their language. So I am not scared. We have 1.5 days to go. We did, alleviate my concerns. However, if at the end of day today, we are below 28,000, even by $1, I will be lower in my position. I will stay with my bullish position through the Fed call. I will deal with the volatility as it comes over the next few hours. But if at 4 p.m. today, or if somewhere between 4 p.m. and 8 p.m., let me not put myself into a corner here. Somewhere between 4 p.m. and 8 p.m., because 8 p.m. is when the candle changes to the next daily candle. Somewhere between 4 p.m. and 8 p.m. Eastern time. I'm always on Eastern time, even when I'm not on Eastern time. I'm in Panama. It is 1 hour earlier here. It is not 2 p.m. It is 1 p.m. here. So we will, I will take some bullish positions off the table if we are between, if we are under 28,000 between, say, 3:50 and 8 p.m. Guys, it should be obvious what miner I trust the most. Can someone in the live chat please answer JMT Trade's question as to what miner I trust the most? This has been said on this channel hundreds of times, and unfortunately, you clearly have not watched my channel all that often, but I will let the live chat answer for me as to what miner is my favorite miner. All right, in the next 3 minutes, I just want to do a quick shill of the MRI indicator, which you can find on Products and Services MRI indicator and on demand videos, where you can learn the basics of trading. Someone said BlockFi. That's funny. Surprised no one is trolling by saying Bitmain. There it is. There's Bitmain. Or Butterfly Labs or something. So, yeah, so you can check out those videos as well. We got 2 minutes before all hell breaks loose. We have the daily chart. The daily chart has recovered. We have not even had a close below the 50-period moving average. We are now have an entire body above the 50-period moving average. We really do need to rally off of this immediately. Otherwise, we are in trouble. I'm going to delete this arrow for now. And I would rather replace that arrow. I should have just turned the arrow. I am still in favor of a rally off the 50-period moving average. I will trust the 50-period moving average as support until it's not. It's been support so far. I will trust it until it isn't. Short-term chart. You know what? I don't want to miss it. All right, what the hell is going on here? Real quick, oil has collapsed again. I don't have an explanation for you guys yet. I need to research this myself still. Other than please remind me in exactly 10 days when the U.S. petroleum reserves get announced for this period of time. It's not going to be this Thursday. It'll be next Thursday. So maybe in a week, we will know whether this was the U.S. government selling 100 million barrels of oil. Gold is back to a new all-time high. very bullish. I need to talk to Joe Carlosari about how his gold short trade's going without looking like an asshole. Because I have been bullish on gold, anticipating a small correction, but nothing to be concerned about. And now we're going to go on a low level time frame. We are on the S&P. Let's go straight to the, I think the 1 minute could be a bit extreme, but we are Bitcoiners. And on Bitcoin, we're also going to go to 1 minute, and we're going to compare the two. And we're going to see who's the leader, who's the lagger, and how this all plays out. Here we go. The announcement has been made. The bots have read it, and of course, they crashed the market. Just as expected, just as predicted. Bitcoin so far is holding strong. The S&P has already recovered and went up, and boom, there it goes. Is it possible they did not raise? Is it possible they did not raise at 25 basis points? I have no idea. Bitcoin is rallying. Again, this is expected. Last time, statistically, the stock market did go up at first, but then by the end of the day, it went down. We are looking at a serious dark mode candle right now on the S&P. This is a crazy minute. This is why you need to have cojones of steel to trade right here, right now on a short-term time level in the futures market. This is why when I would be holding through this day, it would be on a longer-term, no leverage situation. Fed hikes 25 basis points. Thank you so much. Tolls for giving us the update. If there is a statement, I know you guys can't post links. I'm just going to let Powell read the statement. I don't want to glance away from the charts to read the statement, even though I could pull it up on the side. There is a news announcement. Maybe we can click on that. Private job growth. Nope. TradingView is not as fast in updating us on the Fed rate. So far, so good. So far, we are bullish. I would love to see the weekly chart of the S&P close as a green candle. That is big. That is very, very important. We are coming up on an MRI sell very, very soon, which is also very, very interesting. Powell says U.S. must capitulate. I have no clue what the hell that means. Capitulation means a complete and utter disastrous crash, unless the definition of capitulation has somehow changed the way the definition of a vaccine and natural immunity, though I did not say that. Hopefully YouTube will not ban me for that random outburst of Tourette's. Let's go back to the 1 minute chart. So far, we have a complete correlation between the S&P and Bitcoin, even at a 1 minute scale. You can see the volatile first minute candle at 2 p.m., which closed green. Then we had a red candle, and now the S&P is printing a red candle, and Bitcoin is about to print a red candle. You can also see that the S&P is the leader right here, right now, that the S&P is already red, and Bitcoin candle is struggling. Does the FOMC matter if there's a rate hike or a rate decline? On a bigger scale, no. On a shorter scale, it matters very much. You can see it right now that within the first 60 seconds of the rate announcement, the S&P had a 20-point candle within a single minute. That is huge. That is a 0.5% move in the S&P. So yes, the FOMC significantly matters, and the shorter your time scale, the more it matters. So it matters the most in a 60-second window, and then it matters the second most on a 1 hour window, and then it matters the third most on a 1 day window, and then to a lesser extent on a weekly window, and to an almost no meaning whatsoever on a yearly or a multi-yearly level. The end of Fed discussion is super, super interesting. I want to end the current version of the Fed, but as I've stated and debated with people in spaces and explained on this channel, I do not believe that the original vision of the Federal Reserve was evil. I believe that the original vision was slightly more beneficial to to stabilizing the financial markets than not. But the original vision only lasted for about 6 months, and then the government completely abused the Fed and continued to do so even more so with every passing year. So I don't mind the original vision of the Fed, and if it was managed the way it was originally designed. I know there was lots of, let's say, questionable means in adding the Fed to the into legislation. That is certainly questionable. It's how it was done, when it was done. It was done over Christmas holidays. It was done in a suspicious way. I understand all that, but the original vision for the Fed was not malicious. It was not evil. It was actually the best thinking of the top bankers who did want this country to do better in the future. The original vision was not evil. It might have been a little misguided, but it certainly wasn't evil, like the conspiracy theories of the Fed will want you to believe. The current Federal Reserve is completely evil. So yes, I would certainly be in favor of removing the current Federal Reserve, but I would be potentially okay with an original vision of the Federal Reserve, which we're not going to get into right now. If you are curious about the original vision of the Federal Reserve, please go to tonevays.com. In products and services, go to publications. In publications. Oh boy, is it in publications? You know what? You might have to go to the blog. Go to Tone Vays blog. Google the word Fed in the search box. You will find an old anarchist interview. This is an interview with Jeff Berwick, who is one of the more unethical, scammier people in the space. You can also go and watch The Anarchists on HBO. Do a shot every time you see me as a cameo. I'm in there as a cameo 3 times. You can watch this interview if you like. It's an old interview. This is from 2015, and I think I did the interview before December. And I posted a bunch of links here. So if you want to learn about the original vision of the Federal Reserve and how the book Creature from Jekyll Island is a little bit dramatic and a little bit unreasonably conspiratorial, just read these. These are your most important reads. And then for additional information, read these. They are all from one single source. That source is Martin Armstrong, who's one of my favorite economic, currency, and financial historians. I may not be a fan of his, trading ideas and his trading model and his views on Bitcoin, but as a historian on how currencies and countries rise and fall due to economics, I think he's one of the best in the world. This is his explanation of the original vision of the Federal Reserve, why it was created, how it was created, and what it was meant to do. And before you criticize the Fed, you need to be aware of this alternative view as for the original true vision of the Federal Reserve by J.P. Morgan himself, the founder of J.P. Morgan companies and now the Chase Bank. Okay, back to the chart. We got 22 minutes before the Fed call. We have weathered the storm. How does it look on a daily scale? The weekly scale doesn't really mean much right now, so we're going to flip this chart to the daily scale. We're going to make it bigger. We are so far bullish on the day. That is important. So besides being bullish on the day, I want to capture the price at which the S&P 500 traded 1 second before at the right here. So we're going to capture this price. And this is our Mendoza line for where the price was the moment the rate was announced. And so far, it has meant absolutely nothing. At least a second ago, it did not. And we can do the same for Bitcoin. We can draw a line as to where the Fed announcement took place. It was right there. So that's our line. That's our break-even line as of the Fed, and our daily line is a little bit different. I am a mathematician, questionable, but a mathematician, according to some of my degrees, and I will stick with statistics. I will trust probabilities. I will trust statistics. This is why I don't really gamble at a casino other than poker, because it does require skill. And if I'm not playing poker, I will be playing blackjack, because if you know when to hit and when to stay and when to double down, it is some of the best odds in the house. The best odds in the house is, of course, craps, but I don't know. I don't know that game very well, so I don't play craps. But I do play blackjack sometimes, and because I know my probability and statistics. So I will anticipate today closing as an update, like it usually does from a historical perspective. Back to the charts. Somebody want me to take a look at Alibaba before I forget? Is it 2 L's? No, 1. Alibaba was doing terrible. Everything Chinese has been doing terrible. And I believe the reason for everything Chinese is doing terrible is because they had a very horrendous zero COVID policy, which was not only scientifically illiterate, it was also economically illiterate, which is unfortunate. And I can go into all kinds of conspiracy theories as to why they did the zero COVID policy in China. This looks like a terrible chart, and I would never buy this thing. It looks like a complete and utter disaster. Let's go back here. My personal conspiracy on why China did a zero COVID policy is twofold. One, they wanted their population as locked down as possible in order to put in their ultimate measures of surveillance and control over their population in peace, without too many people walking around the streets. And the second reason, which is a quasi reason, is they wanted to test how much they can get away with their population. Like how much, where is the breaking point before people rebel and completely overthrow the current Chinese government? They wanted to push that to a limit to know where that limit is. No different than, say, Canada or Australia and New Zealand, and the brainwashed leaders of those countries coming right out of Klaus Schwab's Young Global Leader program wanted to also test the population of the West as to how much they can get away with. Can they make concentration camps? Can they, get us to chip ourselves? Can they get us to at least have a vaccine passport? Can they force vaccination onto every single person? Can they get away with shutting down bank accounts for $20 transactions? So the West tested their way of the system. The US tried this as well. But it was really, really done in Australia, New Zealand, and Canada. Very docile population, completely brainwashed to authority, mostly, and with leaders that were absolutely perfect to implement the test. So China had a very similar test, but for completely different reasons. So that's kind of my personal view on the China zero COVID policy, in a similar light to the young global leaders in charge of the countries I've named. Yeah, royal family is a big factor. The Queen was significantly more based than the current king. The current king is completely woke, and that's a bit of an issue. And his kids are even more woke. So it's unfortunate what has happened to the royal family. I don't think he's going to raise it next meeting. I think the only way he can raise the interest rate next meeting, thank you, CA, for putting Tone Vays back on track and away from geopolitics and conspiracies. Though I would love to talk about another one where this whole COVID thing was a way to prevent the loss of control by the elites on people's ability to travel and work remotely, though, of course, they created a bigger problem with everyone now working remotely. So, as always, stupid attempts to control the population fail. So, I don't believe, we can go to percentages, right? I think tomorrow would be very, very interesting. I don't know how fast this updates. This should obviously say 100%. Nope. Some people still think that the Fed may not raise interest rates that it did 30 minutes ago, but that's okay. So we can go to June, and you can see how, whoa. Oh, no, this hasn't updated yet. Okay, we have to wait. Right, so this means that it's going to stay the same because this hasn't updated yet. We can talk about this tomorrow. I don't believe the Fed is going to raise interest rates. I think the default position is going to be not to raise interest rates next term. However, there are exceptions. The biggest exception as to why the Fed might actually raise interest rates, there is three. There is three reasons. And if all three work out, or the majority of the three work out, and I don't mean 2 out of the 3 work out, I mean, they're not hard lines. They are, it's always a sliding scale. But here are the 3 things that would cause the Fed to raise interest rates next term. One is the CPI. I believe the CPI comes out next week because it's not on this week's schedule. The CPI, if inflation stays high, the Fed may raise interest rates. If unemployment stays low, the Fed might raise interest rates because people working is for some reason bad for the US economy. So too many people having jobs could create an environment where the Fed would raise interest rates in order to create more job loss. But it wouldn't actually create more job loss. This is the weird part, because as these rates rise, people that are capable in saving some money can now earn a bit of an interest rate, right? Retirees can now earn an interest rate, right? Like, imagine a situation. Imagine a situation where you have worked your entire life and you are now 60 years old, 60, 65 years old. You've worked a decent job and you were saving for retirement, and you were smart enough that in your last 40 years, of working, you are now 60. You started work when you were 20. You didn't do the stupidity of Tone Vays and spent 7 years in college getting multiple degrees. That was borderline dumb, but I don't really regret it. You started your working career closer to 20 than unlike this bum at like 27. And you've been investing in the S&P 500. Let's say you've even started investing in the S&P 500 back here because you were smart. You started investing, let's pick the most horrendous day you could have started investing if you are pushing 60. You started investing right here on the MRI sell because you were not paying attention to the MRI back in 1987. And you decided to start your retirement process right here in 1987 in September. And the first thing that happened to your retirement account is the loss of 25%, okay? But you did not listen to the gloom and doomers, and you continued to hold the S&P 500 and only the S&P 500 for your retirement. You took full advantage of your employer match, and your portfolio would have made over 1,000% from the beginning, but of course you were adding on all throughout. And there is a very high probability you would be sitting on over $1 million today, easily over $1 million today in your retirement account if you were putting like say 3,000 to 5,000 away per year, and then watching it go up 10x on top of that as you are putting money in there. Now you have $1 to $2 million in your retirement account, which anyone over the age of 60 today with a decent job throughout that time could have done. Okay, it's a simple Excel. I can even do an exponential function, right? You are allowed to invest. I don't know why I'm on this tangent, guys. We have to listen to Powell in a minute. And never do live math. I have 2 math degrees. Don't ever do live math. Don't ever do math on live air. It's a golden rule. So let's say you put $6,000. Well, 6,000 is a bit of a stretch, right? You couldn't put $6,000 away in the 1980s. Let's say you put on average $3,000 into your retirement account, right? And you did it every year for 30 years. Okay, I'm not even going to go to 40 years. I'm going to go 30 years. Okay, that is already $90,000. That is only at 3,000, but it was in the S&P 500, which were making you money over and over again with dividends reinvested. Okay, and for the returns that you weren't making early on, now you could put $6,000, and your employer match could make it $12,000, right, in your retirement account if you have a job that has an employer match. So you can easily have $1 million. Okay, and now the interest rate is over 5%. So you could easily put it. I hate government bonds. I really, really do. But you can put it in short-term money market. You can put it. You can leave it in the S&P 500 even. Okay. There's all these kinds of things you can do with this money, and you can easily earn 5% to 10% a year on your money. Easily earn 5 to 10% a year on your money. So if you are lucky and you are earning 8% on your money, what is 8% of $1 million? Times 0.05. That is 5%. Okay, that's 5%. Forgot to put an equal sign. Right, that's $50,000. You can earn $50,000 by doing nothing if you save properly for retirement, and you can maintain that $1 million if you think you're going to live to 90. But I don't know how long the interest rate will stay this way. Now, $50,000 may not be enough to live in Manhattan. It's certainly not enough to live in San Francisco if you want to step over homeless people every 3 seconds, right? But it's certainly enough money to live in Thailand. It is certainly enough money to live in Colombia. It's more than enough money to live in many amazing countries. Georgia, for example, which I know is a little bit scary with Russia on the border, but there are so many incredible countries. A few years ago, I would have said Ukraine. Not saying that anymore, but you could also move, right? So there are many countries where you could have enjoyed your life on $50,000 a year is more than enough money. It depends on your habits. Again, if you're in Thailand for certain reasons, $50,000 might go a long way or may go a short way. It depends on your preferences. But in any case, same thing with Colombia and certain drug preferences. It's not enough money to live in Dubai, that's for damn sure. But there's places besides Dubai that may be of interest. Okay, back to the chart. And we are positive. This is great. So far, it's working out perfectly. So this took about, what, 10 minutes? So in the first 10 minutes, we dropped and made a low. 10 to 15 minutes later, if we look at the original paper from 20 years ago, 15 years ago, you can see this is the full day. I would say that is approximately 10 minutes. If I draw a line down, it's about 10 to 15 minutes right here where it tends to make the low. And then the high seems to be made around, I would say, 3 p.m. Around 3 p.m. is where the top is made. But since this was happening 15 minutes later, I would say the top would be made somewhere around 2:45, somewhere in the middle of a speech is the top, and then we pull back a little bit into end of day. This is the standard way of how market behaves on a day like today. And so far, it is playing out exactly like that on a 1 minute scale chart. All right, let me look at your live chat, and then we're going to go to a live press conference by Jerome Powell. Alex, I don't know if I would max leverage short Alibaba, but the chart does look terrible. Barfings, nice name. Thank you for the suggestion. He's suggesting it's best to get in at ground market open the first day and exit at market close on the third day. But by first day, you mean the day before the drift. So you mean the day before the announcement. So your suggestion is to get in over here on day -1. This is day -1, this is day 0, and this is day +1. You're suggesting I do suggest get in market open. I agree with that. And then, you get out sometime on day 3, or maybe even at the end of day on day 2, on day 0, at the end of day on day 0. Oil bottoming. Oil is weird. I'm sorry, guys. I have no comments on oil. I am dumbfounded. I am confused. I don't understand what's happening. Maybe the OPEC countries are going to get together and have another oil cut because they want a higher price of oil. The US wants a lower price of oil. I don't know if this is pure manipulation or market driven. This is why I cannot answer. This is why I don't have an explanation. And it's very difficult to know who to trust in their expertise of the oil markets. Hey guys, real quick, I know I only have 4 minutes, and we are going to get back on schedule of talking about FOMC, and we're going to listen to Powell live. What I want to show you guys real quick is there's been lots of discussions of Robert F. Kennedy Jr. I want to play this. It's only a 45-second clip. I'm actually going to play this one. It's a 49-second clip, has an extra few seconds. And this is my huge concern with, oh, wait, let me turn on my portable speaker and connect it to the Bluetooth. Give me a second. And I'm running low on time. I got 3 minutes to do what I want to do before we go to Powell live. But nothing ever starts on time. Bluetooth devices. Because right now I'll be connected to my phone, which I don't want to be connected to. So I'm going to turn that off. Show Bluetooth devices. And I want to connect my JBL. Connect. Let's see if that works. Not yet. Not yet. Oh boy. Connecting you, that didn't work. Make sure your Bluetooth device is still viewable. Let me try again. 2 minutes. Connect one more time. If it doesn't work, I'll have to do it the inconvenient way. It doesn't look like it's going to work, so that's okay. It did not work. Okay, I'll have to redo that. Never do stuff on live air. I think you guys can hear it just fine through my laptop.
I think they should be in jail. I think they should be enjoying pretty hot and caught at the Hague with all the other war criminals with it. What about politicians, people who deny, who express emphasis like they're selling out the public trust? And I think those guys who are doing the Koch brothers bidding.
I'm sorry, guys. I think I'm on fast speed. That should not have been normal speed. My bad. Let's go way to the beginning. It starts off really abrupt. The question was, what do you think should be done with people that deny global warming and climate change? And here's his answer. Should.
Well, I think they should be in jail. I think they should be enjoying free hots and a cot at the Hague with all the other war criminals who are there. What about politicians, people who deny, who express skepticism? They're selling out the public trust. And, I think those guys who are doing the Koch brothers bidding and who are against all the evidence of the rational mind are saying that global warming doesn't exist, that they are contemptible human beings, and that, I wish that there were a law you could punish them under.
I guess I'm a little disappointed.
Right. So that is a huge concern that RFK wants to jail people who deny global warming, and he even said global warming. It is now climate change because the global warming narrative was bullshit. The planet's now warming, so they had to, of course, change their view that it's now called climate change. I'm also going to suggest this documentary called "To the Last Ukrainian." I've been watching it in pieces. I only have like 15 more minutes to watch. It's like an hour and a half, hour 44 minutes. I'm almost done with it. I would recommend it. It's a little counter narrative, and I don't understand how it's still possible that it's on YouTube. Okay, and on this note, we're going to go live to his speech. And I would like to get my speaker to work, so I'm going to keep playing around with my settings. Can you guys hear me though? His pro crypto. I don't believe him. I just don't believe him. I'm sorry. I believe RFK on his views of COVID, but I don't believe him that he's going to take the military. He's going to close U.S. military bases. I don't believe him, and I don't believe him on Bitcoin. But I do believe him that on climate change, of what he says.
Today's recent developments in the banking sector.
Shoot. Can you guys hear
The
this?
sector have broadly improved since early March, and the U.S. banking system is sound and resilient. We will continue to monitor to learning the right lesson to prevent events like these from happening again. As a first step in that process, last week, we reviewed Federal Reserve's supervision and regulation of Silicon Valley Bank. The review's findings underscore the need to address our rules and supervise with maximum employment and stable prices for the American people. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. Without at all. Interest rate by a 1/4 percentage point. Since early last year, we've raised interest rates by a total of 5 percentage points in order to attain a stance of monetary policy that is sufficiently to return inflation to 2% over time.
I'm going to work on the audio.
We are also continuing to reduce our securities holdings. Looking ahead, we'll take a data-dependent approach in determining the extent to which additional policy firming may be appropriate. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy slowed significantly last year, with real GDP rising at a below trend pace of 0.9%. The pace of economic growth in the first quarter of this year continued to be modest at 1.1%, despite a pickup in consumer spending. Activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains very tight. Over the first 3 months of the year, job gains averaged 345,000 jobs per month. The unemployment rate remained very low in March at 3.5%. Even so, there are some signs that supply and demand in the labor market are 25. Nominal wage growth has shown some signs of easing, and job vacancies
I'm going to try to find it on YouTube. Their site might be overloaded. Where's my volume thing?
Vacancies have declined so far this year. But overall, labor
There.
demand still substantially exceeds the TE prices rose. Inflation has moderated somewhat since the middle of last year.
This is way better.
Nonetheless, inflation pressures continue to run high.
Audio is
And
way
the
better now.
process of getting inflation back down to toe. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, process of getting transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective.
I'm going to switch to YouTube.
At today's meeting, the committee raised the target range for the federal funds rate by a 1/4 percentage point, target range to 5 to 5.25%. And we're continuing the process of significantly reducing our securities holdings. With today's action, we have raised. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed bringing the target range to 5 to 5.25%. And we're continuing the process of significantly reducing our securities holdings. With today's action, we have raised interest rates by 5 percentage points in a little more than a year. We are seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, particularly housing and investment. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In addition, the economy is likely to face further headwinds from tighter credit conditions. Credit conditions had already been tightening over the past year or so in response to our policy actions and a softer economic outlook. But the strains that emerged in the banking sector in early March appear to be resulting in even tighter credit conditions for households and businesses. In turn, these tighter credit conditions are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain. In light of these uncertain headwinds, along with monetary policy restraint we've put in place, our future policy actions will depend on how events unfold. In determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We will make that determination meeting by meeting based on the totality of incoming data and their implications for the outlook for economic activity and inflation. Monetary policy restraint is warranted. Goal and to keep our longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential.
Oh, great. I don't think my internet's down. You guys still hear me? We can look for another YouTube channel. Maybe my internet is. No, there it is.
stage for achieving employment and stable prices over the longer run. To conclude, that's a meaningful change that we're no longer.
Let's go
saying that
back
we
because I don't know what he said.
And so we'll be driven by incoming data and meeting by meeting based on the totality of.
I'll just
incoming
speed it
data
up.
And the for the outlook for economic activity. Greater monetary policy restraint is warranted. We remain committed to bringing inflation back down to our 2% goal and to keep.
Oh God,
long-term
the troll
expectations
treasure.
well anchored. Reducing inflation is likely to require a period of below trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses.
Oh, look at the market.
Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thanks, Gina.
Who's got those bolts of steel?
Hi, Gina Smilik, New York Times. Thanks for taking our questions.
Oh
I
God,
wonder
New
if
York
you can tell
Times.
us whether we should
Good
read the statement
Lord.
today as a suggestion that the committee is prepared to pause interest rate increases in June. And I also wonder if the Fed staff has in any way revised their forecast for a mild recession from the March minutes. And if so, what a recession like what they're envisioning would look and feel like when it comes to, for example, the unemployment rate.
All right, those are actually a good question.
So in your course today, our decision. Will take into account certain factors. So that's a meaningful change that we're no longer saying that we anticipate. And so we'll be driven by incoming data, meeting by meeting, and we'll approach that question at the June meeting. So the staff's forecast is so. Let me start by saying that that's not my own most likely case, which is really that the economy will continue to grow. That's so different people have different forecasts. That's my own assessment of the most likely path. Staff produces its own forecast, and it's independent of the forecasts of the participants, which include the governors and the Reserve Bank presidents, of course. And we think this is a healthy thing, that the staff is writing down what they really think. They're not especially influenced by what the governors think, and vice versa. The governors are not taking what the staff says and just writing that down. So it's actually good that the staff and individual participants can have different perspectives. So broadly, the forecast was for a mild recession, and by that I would characterize as one in which the rise in unemployment is smaller than has been typical in modern era recessions.
Chance the stable.
I wouldn't want to characterize the staff's forecast for this meeting. We'll leave that to the minutes, but broadly similar to that.
Rachel.
Thank you, Chair Powell, Siegel from the Washington Post. Thanks for taking our questions.
Oh, here we go.
I'm wondering if you can talk
I mean-
about possible effects of a debt limit standoff. You've said repeatedly that the ceiling must be raised, but do you see any economics effects of even getting close to a default? And what type of situation would that look like?
She has the worst
So
question.
I wouldn't want to
Oh my
speculate
God.
specifically, but I will.
Why do they keep letting her
Fiscal
in
policy
there?
matters for starters, and they're
Terrible.
therefore Congress and the administration for the elected parts of the government to deal with, and they're really consigned to them. From our
That's her,
standpoint,
Rachel
I
Siegel.
would just say this:
Always
it's
forget her
essential
name, but I
that
know
the
she's
debt's
from
only be
Washington
raised in a timely way, so that the U.S.
Oh,
government
God.
can pay all of its bills when they're due. Failure to do that would be unprecedented. We'd be in uncharted territory, and the consequences to the U.S. economy would be highly uncertain and could be quite averse. So I'll just leave it there. We don't give advice to either side. We just would point out that it's very important that this be done. And the other point I'll make about that, though, is that no one should assume that the Fed can protect the economy from the potential.
How do you play audio
short and
only? I have
long-term
to play
effects
video with the audio.
of a failure to pay our bills on time. It would be so uncertain that it's just as important that we never get to a place where we're actually talking about or even having a situation where the U.S. government's not paying its bills.
And just to follow up, was discussion around the uncertainty of a possible standoff, did that affect today's monetary policy decision at all?
I wouldn't say
No.
that it did. It was, of course, it's something that came up. We talk a lot about risks to the outlook, and that come up. A number of people did raise that as a risk to the outlook. I wouldn't say that it was important in today's monetary policy decision.
Oh, thank you. Steve Leisman, CNBC. Can you tell us what the Federal Reserve Board did in the wake of that February presentation where you were informed that Silicon Valley Bank and other banks were experiencing interest rate risks. And can you tell me what supervisory actions you've done in the wake of the recent bank failures to make sure that banks are currently appropriately managing interest rate risk? And kind of part three, but it's all the same question here. Do you still think this separation principle that monetary policy and supervision can be handled with different tools? Thank you.
Sure. So the February 14th presentation, I didn't remember it very well, but now, of course, I've gone back and looked at it very carefully. I did remember it. And what it was a general presentation. It was an informational briefing.
I think there's way better questions.
I think all members were there. And it was about interest rate risk in the banks and lots of data. And there was one page on Silicon Valley Bank, which talked about, the amount of losses they or mark-to-market losses they had in their portfolio. There was nothing in it about, that I recall anyway, about the risk of a bank run. So it was, I think the takeaway was they were going away to do an assessment, a horizontal assessment of banks. It wasn't presented as an urgent or alarming situation. It was presented as an informational, non-decisional kind of a thing. And I thought it was a good presentation. And as I said, did remember it.
Let's see what these people look
In
like.
terms of what we're doing, of course,
But I can
I
minimize
think banks
all of
themselves or many banks are now are attending to liquidity and taking opportunity now, really since the events of early March.
I don't know if it'll be better or not, but we'll just watch the market as it reacts to
but the separation principle, like so many things, it's very useful. But ultimately it has its limits. I mean, I think in this particular case, we have found that monetary policy tools and the financial stability tools are not in conflict. They're working well together. We've used our financial stability tools to support banks through our lending facilities. And at the same time, we've been able to use our monetary policy tools to foster maximum employment and price stability.
I don't mean to be argumentative, but the staff report said SVB has significant interest rate risk. It said interest rate risk measurements failed at SVB, and it said banks with large unrealized losses.
Can't really lower the
safety and
quality.
soundness risk. Why was that not alarming?
I can lower it to 144.
Well, I mean, I didn't say it wasn't alarming. It was, they're pointing out something that they're working on and that they're on the case that I'm not sure whether they mentioned, I think they did actually, they mentioned that they had taken regulatory action, or supervisory action in the form of matters requiring attention. So I think that was also in the presentation. I think it was to say, yes, this is a bank and there are many other banks that are experiencing these things and we're on the case.
Sure, Powell. I wanted to ask you, obviously, with the recent bank turmoil, we've seen multiple banks buy other banks. And I was just curious whether you think that further consolidation in the banking sector would increase or decrease financial stability, and whether you have any concerns about the biggest bank in the US getting even larger.
So
that's a good question.
We certainly don't. I don't have an agenda to further consolidate banks. Consolidation has been a factor in the US banking industry really since interstate banking, and before that, even it goes back more than 30 years. When I was in the government a while back, I think there were 14.
It's going to go to one by itself in a few seconds.
Change. So that's going on. I personally have long felt that having small, medium, and large size banks is a great part of our banking system. The community banks serve particular customers very well. Regional banks serve very important purposes, and the various kinds of GSIBs do as well. So I think it's healthy to have a range of different kinds.
It should be at one any second now.
I think that's a positive thing. Is it a financial? So I would just say in terms of JP Morgan,
once I catch up,
buying First Republic, the FDIC really runs the process of closing and selling a closed bank completely. That is their role. So I really don't have a comment on that process. As you know, there's an exception to the deposit cap for a failing bank. So it was legitimate. And I think that the FDIC, I believe, is bound by law to take the bid that is the least cost bid. So I would assume that's what they did.
So the markets are flat.
In fact, they're getting larger in general.
So I think it's probably good policy that we don't want the largest banks doing big acquisitions.
Bitcoin
that is the policy. And but this is an exception for a failing bank. And I think it's actually a good outcome for the banking system. It also would have been a good outcome for the banking system had one of the regional banks bought this company. And that could have been the outcome. But ultimately, we have to follow the law in our agencies, and the law as it goes to the least cost bid.
Thank you, Colby Smith with the Financial Times. At the March meeting, you mentioned that tightening of credit conditions from the recent bank stress could be equal to one or more rate increases. What is your estimate?
To have a precise estimate of the words to that effect. But in principle, that's the idea. When we've been raising interest rates, and that raises the price of credit.
I don't want to click clock because then I'll skip
restricts
stuff.
credit in the economy, working through the price mechanism. And when banks raise their credit standards, that can also make credit tighter in a kind of broadly similar way. It isn't possible to make a kind of clean translation between one and the other. Trying that and assessment. So it does complicate the task of achieving, a sufficiently restrictive stance. But I think conceptually, though, we think that, interest rates, in principle, we won't have to raise rates quite as high as we would have had this not happened. The extent of that is so hard to predict because we don't know how persistent these effects will be. We don't know how large they'll be and how long they'll take to be transmitted. But that's what we'll be watching carefully to find out.
Just to quickly follow up about the scope for the committee to pause rate increases perhaps as early as next month, even if the data remains strong, then if it's having some kind of substitute effect.
This is just something that we have to factor in as we want to find ourselves. So I guess I would say it this way.
As we want to find ourselves
of the extent to which additional
That's
policy funding may be appropriate is going to be an ongoing one, meeting by meeting, and we're going to be looking at the factors that I mentioned that they're listed in the statement, the obvious factors. That's the way we're going to be thinking about it, and that's really all we can do. As I said, it does complicate. We have a broad understanding of monetary policy. Credit tightening is a different thing. There's a lot of literature on that, but translating it into rate hikes is uncertain. Let's say it adds even further uncertainty. Nonetheless, we'll be able to see what's happening with credit conditions, what's happening with lending. There's a lot of data on that, and we'll factor that into our decision making.
Howard Shire with Reuters. Thank you.
I think we're at 1x now.
Drop the reference to sufficiently restrictive. I was wondering, given your baseline outlook, whether you feel this current rate of 5 to 5.25% is in fact sufficiently restrictive.
So that's going to be an ongoing assessment. We're going to need data to accumulate on that. Not an assessment that we've made as that would mean we think we've reached that point, and I just think it's not possible to say that with confidence now. But nonetheless, you will know that the summary of economic projections from the March meeting showed that at that point in time that the median participant thought that this was the appropriate level of the ultimate high level of rates. We don't know that. We'll revisit that at the June meeting, and that's we're just going to have to, before we really declare that, I think we're going to have to see data accumulating and make that, as I mentioned, it's an ongoing assessment.
I follow up on credit. Could you give us a sense of what the SLOOS survey indicated? It was already, I think 45% of banks were tightening credit as of the last survey. What did this one show, and how did that weigh into your deliberations?
So we're going to release the results of the SLOOS on May 8th in line with our usual time frame. And I would just say that the SLOOS is broadly consistent when you see it with how we and others have been thinking about the situation and what we're seeing from other sources. You will have seen the Beige Book and listened to the various earnings calls that indicate that mid-sized banks some of them have been tightening their lending standards. Banking data will show that lending has continued to grow, but the pace has been slowing really since the second half of last year.
I'm Nick Timmerows from the Wall Street Journal. Chair Powell, the argument around the end of last year and the beginning of this year to slow down the pace of increases was to give yourself time to study the effects of those moves. After the bank failures in March, as you've discussed, the Fed staff projected a recession starting later this year. So my question is why it was necessary to raise interest rates today, or put differently, if the whole point of slowing down the pace was to see the effects of your moves, and now you've, for the last two meetings, been seeing the effects of those moves, why did the committee feel it was necessary to keep moving?
Well, the reason is that again, with our monetary policy, we're trying to reach and then stay at for an extended period, a level of policy stance that's sufficiently restrictive to bring inflation down to 2% over time. And that's what we're trying to do with our tool. I think slowing down was the right move. I think it's enabled us to see more data, and it will continue to do so. So we really we have to balance. We always have to balance the risk of not doing enough and not getting inflation under control against the risk of maybe slowing down economic activity too much. And we thought that this rate hike, along with the meaningful change in our policy statement, was the right.
I think
way
we're
to
gonna
balance that.
close
And
the
just to
YouTube in a
follow
minute.
up, you know, what you said in response to Howard's
Oh, wait,
question, you'll
that's not
need
that one.
data to accumulate to determine if this is a sufficiently restrictive stance. Does that data need to accumulate, or could it accumulate over a longer period than a 6-week intermeeting cycle?
Yeah, I mean, as I mentioned, I would just say that this assessment will be an ongoing one.
All right, this is not going to get us any further. We got as much out of it as we will. The Fed raised the 25 basis points. They are being as vague as possible. I don't know if you can be possibly more vague as to what will happen at the next meeting. They have no idea. They want to make sure that the market has absolutely no idea what their idea is about the next meeting. I believe they will not be raising rates next meeting. And as I said earlier, there are 3 conditions that will cause them to raise rates. I only discussed 2 of them. I didn't get a chance to talk about the third. So one of them is if CPI is high, if inflation remains stubborn and high, which I believe that it will, that's for them to raise rates. If unemployment stays low, that's a reason for them to raise rates, but it is a reason for them to raise rates. And the third and final reason, and the Fed will never, ever, ever admit to this, but the third and final reason is the stock market. If the stock market is rising and is performing well, and they will not damage the bullishness of the stock market by raising rates, they will raise rates. If the stock market turns and starts to crash, that will cause them to think twice about raising rates. So as long as those 3 things are at status quo, the market is slightly rising. Unemployment is steady or declining very slowly, and unemployment is steady or not increasing quickly. That combination of 3 things will cause them to raise rates one more time for a 1/4 basis point, and they will once again pray that they do not break ship. Now, when Powell says he is not in the business of consolidating banks, he is not lying. He is not in the business of consolidating rates, but the administration, the other forms of government, the forms of government whose actual job it is to rule over people like slaves, they are very, very happy that the banks are consolidating. So while he is not trying to cause that on purpose, he knows that the administration will tolerate him as long as the things that he's breaking are acceptable to the current administration. Didn't Powell admit to the Russian pranksters? I don't know that one. I know the Russian pranksters got Christine Lagarde. I didn't know they got Powell. Turn his mic off. Do that? Didn't I close it all? You guys hear me okay, right? I think. You should, yeah. You guys do hear me okay, right? Yeah. So we can go back to the market. There's not much else to say on this. The market has been volatile. It made a low, it made a high. It's not being very useful right now. It's not moving one day or another. All roads lead to CBDC, probably. Coinbase chart. How about the 30% tax on mining energy? Okay, I don't care. The 30% tax on mining energy is stupid, and the miners will find another home. Eventually, all mining might actually take. Coca-Cola, the stock or the soda? Battery acid as Coca-Cola, but that's just my crazy conspiracy opinion. Tilray. Still bearish. I don't see a change in the chart. Coca-Cola. What's their ticker? I don't think I've ever looked at Coca-Cola stock. I guess it's KO. First time for everything. They're doing well. Well, because the United States is a bunch of sugar guzzling insanity. I mean, for moral reasons, I would never try to profit from Coca-Cola stock unless it's to the downside. Nice MRI buy on the weekly right there. Chart's bullish. I'm not going to deny that. The break of MRI resistance on the weekly chart is going to be very bullish. Zelensky impersonators got Powell. How are these people so stupid? By the way, those Zelensky impersonators ask really good questions. Miners finding another home. Home, not hole. Home. They will move. Miners will move. They'll go to Russia and mine. Like they'll go somewhere. The US is being stupid. They are destroying themselves. Let's see what the Strategic Petroleum Reserve looks like tomorrow when they announce the next number. The same stupidity that is causing them to drain a Strategic Petroleum Reserve, whose #1 priority is the security of the country, not to lower prices at the pump, is being annihilated. And for the same reason, they're going to annihilate Bitcoin mining infrastructure in the US, which is also critical for the future of America as a world leader in many, many things. So once again, the United States is playing the role of the Roman Empire collapsing. This was never as great as the Thanks for stopping by, Micron. NYCB. What is NYCB? New York Community Bank. It's a community. Oh, doing well. Doing well. I don't know. It's bullish. Chart's bullish. I don't know what you want me to say. Chart's bullish. I don't know why. They had great earnings right here. It looks better than all other banks. I'll tell you that much right now. Looks bullish. I don't know if I'd buy into the banks right now, but it certainly looks bullish. Look at that beautiful MRI, third consecutive. Would have been way risky to trade that. Somebody want me to look at oil on an hourly chart. I don't know what to say about oil. I don't have an explanation for you guys. Remind me of the situation in 7 days when we get the petroleum reserve numbers for this week. I mean, maybe like I said, maybe the US sold 20 million barrels of oil this week. I don't know. I don't know what happened. You can see that last week, or see the number for the week of the 28th, right? So on the 28th, we had this much barrels of oil. So in the last week of April, the US government sold 2 million barrels of oil. I don't know how many barrels of oil they sold the first last week. I don't know. We're going to find out. We're going to find out tomorrow. The numbers get released. Well, we'll know tomorrow. But tomorrow's number days. We made. So if the next number here comes in at like 340 million barrels, then we know what drove the price down. But if it comes in, let's say the United States has bought some oil, which I doubt it, then I will be even more confused. But my confusion will be resolved if this number is significantly lower on the next print and the print after that, then we will have an explanation for the big drop of oil. But if that number is not sufficiently lower, then I will not have an explanation for the oil drop. So I'm waiting for those numbers to know if I have an explanation or not. Tone, what's your advice for someone in a shithole country? Just buy Bitcoin, hold it for the next 20 years. You shouldn't have to hold it for 20 years. Or should they learn trading for Syria? No, that's not my advice. There's no good paying jobs. There's always good paying jobs. There's a million good paying jobs, okay? Because you don't have to work in your country. As long as you have access to the internet, you can find a good paying job. You can learn graphic design, you can learn video editing, you can learn marketing, you can learn all kinds of skills that the Filipinos are doing to be people's virtual assistants. You can be someone's virtual assistant. There is all kinds of jobs on the internet. You can start volunteering. Someone who's willing to pay you. There are infinite amount of high-paying jobs for anyone in any country. All it takes is the ability to use YouTube to learn skills that people in wealthy remote countries will pay you to do. So I'm sorry, I do not buy the excuse that there are no good jobs in country X. Now, if there is no good internet in country X, then yes, I will agree with you. But if you are watching my YouTube channel, that means you have access to the internet. And that means you have the ability to learn any skill and be excellent at that skill to earn money, okay? Now, hopefully it is in an ethical way and not an unethical way, but yes, you can do it. Learn something that other people want to pay you for remotely. Which stocks to buy? Come on, guys, serious questions, please. HMST, next regional bank to fail. Maybe. I think we met at dinner over in Costa Rica. All right, guys, I think I'm gonna get going. Oh, Coinbase, you're right. I didn't look at Coinbase stock. So the MRI looks very, very bearish for Coinbase, and their earnings is coming up in a couple of days. So I would not be holding Coinbase to earnings. I would, Coinbase is going to do what Bitcoin does. The best time to buy Coinbase was on a daily MRI buy, within a weekly MRI buy. That was a perfect buying opportunity. Right now, I wouldn't touch it. What needs to happen for you to change your mind about leaving America? Ooh. Well, for starters, Trump needs to get reelected. That's step one. I just don't see anybody else. I mean, Ron Paul is too old. He won't get elected. Rand Paul would be okay. There's a handful of others. For starters, a decent president. Second, actual arrests of criminals in the political system. Hillary, Fauci, Victoria Nuland, Anthony Blinken. I can name names all day. Some actual criminal arrests of the evil people that has put America in this danger, which is unlikely to happen. If Florida and several countries around Florida, because I think Florida alone is not enough. If Florida, Texas, while it can still be saved, Florida, Texas, and all the states in between declared independence, and that was called America going forward, that would be an America I'd want to live in. But me in America is not something unless I'm living in a cabin somewhere. Like, it's just not something I'm looking forward to in the near future. I'm in Panama for multiple reasons, but I'm not saying Panama is the best place. I don't know if I'll be in Panama forever. I'm just currently in Panama. I do need to learn Spanish. If I don't learn Spanish, it'll be very hard to continue living in Panama. I think Mexico is a better option. I'll consider El Salvador if Bukele gets reelected and there is infrastructure progress. I'm sorry, El Salvador is just not. It's not up to my standard of. I'm not saying I'm not saying I need ridiculous luxury. I like my cabin in the woods. I also like a decent restaurant every now and then. El Salvador is just not there yet. I'm sorry, guys. It's a long way to go. And I'm happy that people are building out El Salvador, but maybe in 5 years. Nowhere in Europe, that's for damn sure. I don't know. I don't know where the best place to live is. The best place to live is wherever it's best at the time, and you need the ability to move on a 1 week notice to another country. You need to have the resources to move to another country. That's all I can say. Try to find the resources to move to another country. That means you need to have a remote job. It means you need to be ready to move your family. You need to have the right passport. You need to have the right friends. You need to have the right friends around the world to help you if you need help. So the best place to live is a place that you are not married to, and you can leave from that place. That's the best place to live. I want to visit Venezuela very much. All right, guys. On this note, I'm going to get going. Oh, market's tanking a bit. Let's see how it closes end of day. Let's see where Bitcoin is on a daily chart. So far, I am not in a panic mode. We are still above 28,000. I need this to be breaking 28,000 in order to me taking some off the table. I will likely wait for tomorrow's daily candle for that, which starts in 5 hours. And I will see you all. Guys, check out Unconfiscatable, check out the Financial Summit, 2 incredible events that one day you'll regret not going to. Trust me.